Hey, Dustin.
Hello there. Thanks for having us.
Of course. Beautiful. I am going to just kick things off a little bit, and then Dustin, I'm going to turn it over to you to do an introduction. Okay?
Perfect.
Beautiful. So, first of all, welcome to everyone. If this is your first session for the Advisor Network Virtual Connect 2026, welcome. For a lot of you who are going to be consuming this, you're not consuming it live, you're consuming it afterwards. There's over 7,000 members of our wealth management community that are now part of our overall community network. That's fantastic. We can't thank all of you enough for being a part of this, but we know, especially during the summer, a lot of you aren't able to attend live. The best way to attend live is to join the collaborative platform. The platform has over 250 members where you can be using the interactive collaborative platform every day, asking questions of your peers, and consuming even additional information from our institutional partners. We run two calls every month, one dedicated for our advisor to advisor peer sharing, and the other for our institutional partners to showcase some of their best thinking. And we're excited to do some of that with our partners at Jackson in just a moment or two. Just a key reminder for a few folks, we do have some live events coming up in just the next few weeks. In early August in Saratoga Springs, we have our East Regional meeting, a day of classroom on the 11th, and then a day at the racetrack on the 12th. If you've never been, I promise you it is a place you should be. We're going to be out in the West Coast in October for our one-day meeting in Orange County. And not to be outdone, in November, we have our Advisor Network Connect, the in-person version of this meeting together where folks can get together, share their best practices, and also share a coffee or a cocktail. It's a nice blend between content and collaboration. So without further ado, I'd like to turn it over to Dustin at Jackson to make some introductions.
Yeah, thank you, Colin. And so thank you for having us on the call today. Just real quick, I am the external RIA consultant from Jackson. I cover the New Jersey, New York area. So if anybody ever has any questions on the RIA platform, thinking about RIA, all we have is advisory fee-based type commissions on that platform. I have 11 other counterparts that cover the rest of the country. So if it's not New Jersey, New York, happy to connect you with wherever that takes you. And then without further ado, introducing Glen Franklin. He is our AVP of RA and lead generation strategy here at Jackson, has a ton of research and content that I think is going to really resonate with some of the conversations you might be having with your clients right now. And with that, I'll just let Glenn take it away.
All right. Thanks, Dustin. Thanks, Alex. So good morning, good afternoon, everyone. Just to give you some background on what we're going to be looking at today, over the past 3 years, Jackson has been in a research collaboration with the Center for Retirement Research at Boston College. And the idea was to study 6 major retirement-related risks to provide insight and guidance to advisors for use with their clients and to the clients themselves. So those risks are longevity, inflation, healthcare, market risk, policy risk, and family risk. And today we're going to look at the first 5 of those. Family risk will be released later this year. But with that said, I'll get right into it. Of course, first things first, got to make the compliance folks happy. So just a moment to give you a chance to study this screen. And with that, we will get into it. So first, we'll go through some of the things we learned in each of these studies, and we'll go in chronological order. So we're starting with the longevity risk study. This was our first study, it was executed in 2023. The research on longevity risk entailed looking at how people interact with the concept of life expectancy. In other words, with their own mortality. We specifically define longevity risk as the possibility of depleting financial resources before dying. We found that people were unclear on how to estimate their life expectancy, and they were inaccurate in their estimates. We saw that people were generally not estimating their life expectancy within a year of actuarial averages. More specifically, about 60% overestimated, about a third underestimated, and about 1 in 10 were within a year of the average life expectancy for their age and gender. And for most, a parent's age of death was the basis for thinking about how long they would live. That's not surprising, but while genes matter, it fails to take into account the impact of different lifestyles and the increasing quality of healthcare interventions that may serve to increase longevity. Meanwhile, for the youngest people in this study, those aged 55 to 59, they underpredicted life expectancy most often and by a greater magnitude than most other age groups, potentially amplifying their longevity risk. I do want to note, physical health was also a factor in underestimating life expectancy. The study also included input from financial professionals on how they approach planning for longevity. In general, we found that financial professionals are recommending a longer planning horizon than their clients would anticipate based on their own self-assessment of life expectancy. One somewhat surprising finding was that more than half of investors professed interest in an annuity with guaranteed lifetime income. That was surprising because they were offered an actuarially fair lump sum as an alternative, and in some publicly cited studies, that has been the winning choice. It's the so-called annuity puzzle. At the same time, that level of interest in the context of current market share points to some of the challenges in clearly and concisely describing the benefits of a lifetime income stream from an annuity and in placing one in a retirement portfolio. Finally, with this study, as we generally do with all our research, we looked at the responses by subpopulation or segment. One thing we found, which is consistent with other studies we've done, is that households where a female is the primary decision maker for household financial decisions face unique challenges compared to households where financial decisions are led by males or where decisions are made in equal partnership. Our next study in the series on inflation risk, completed in late 2023 through early 2024, entailed looking at how people deal with rising prices. In other words, how well they were stretching their financial resources. We specifically defined inflation risk as the erosion in value resulting from higher prices. Now, let me start with a side note. As I mentioned before, this study did not have an asshold threshold for participation. Thus, it included a broad mix of consumers and was not limited to retirement investors. We did that so we could compare attitudes on price increases across those with savings and those without. Secondly, we collected responses for this study in October 2023. That was a time when there was widespread belief we were in a recession and dismay over the rapid increases in prices from the prior year. So we're just coming out of the pandemic at that point. We found that a majority of consumers studied were unclear about the current inflation rate. At the same time, almost all financial professionals knew the correct range. Meanwhile, both groups also had different expectations of average inflation for the next few years. 23% of consumers could not make an estimate at all, and only 22% made the correct estimate. 15% expected inflation rates of 8% or more. Alternatively, financial professionals were much clearer on actual rates, with 45% anticipating a rate of 2 to 3%. Now, for reference, the actual CPI-U for all items published by the U.S. Bureau of Labor Statistics in November of 2023 was 3.2%. How do financial professionals manage inflation risk? 84% report using diversification to manage the risk of prices rising during retirement. Around half will use an annuity, either with a guaranteed income stream or a guaranteed floor on investment laws. In this study, we also saw the value of financial advice in that advised households where the financial professional offered guidance on addressing inflation reported that they lost less of their purchasing power. Meanwhile, we also saw something that I'll discuss a bit later. retired households felt less impact from rising prices than pre-retired households still in the workforce. In the consumer segment of the study, we asked people if they followed financial news. If they did, we asked about their primary news source. Not surprisingly, we found that the news source could color the perception of financial news being reported. But we were also able to measure the direction and magnitude of that impact. And finally, consistent with other studies, we found that households where financial decisions were made by a female faced unique challenges compared to those where financial decisions were made by a male or an equal partnership. Now, here are some of the things we learned about healthcare risk from the study we executed in the middle of last year. This was our third study. So looking at healthcare risk entailed looking at how well people understood healthcare costs and long-term care costs. We specifically defined healthcare risk as the potential to deplete financial resources resulting from healthcare or long-term care expenses. First, we saw that pre-retired households are unclear on healthcare costs and long-term care costs in retirement and generally tend to underestimate them. We also saw that relatively few households anticipate the need for long-term care, yet the likelihood of ultimately needing that type of care on average is substantial. And we also learned that retirement investors are generally not receiving guidance from financial professionals on how to plan for or prepare for long-term care expenses, and yet the costs associated with it are the client's highest ranked healthcare concern in retirement. In addition, we learned that people are very focused on cost when thinking about the impact of medical advances over the next 10 years. We asked this question of both retirement investors and financial professionals. 36% of retirement investors and 54% of financial professionals strongly agreed it would increase the cost of healthcare. Alternatively, only 12% of retirement investors and 30% of financial professionals strongly agreed that medical advances would help people stay healthier for a longer period of time. Moreover, people in the study were alarmingly sanguine about using a Medicaid spend down to fund long-term care. For context, participants in the study had to have a minimum of $100,000 in financial assets. The average from the people that did participate was $938,000. There was no required minimum income threshold, and yet, for just the retired households in the study, the average income was about $100,000. Yet, a majority are seemingly okay with giving all that up, as would be required to qualify for Medicaid. Finally, here again, we found that advice, when given, does matter. Specifically, advised households were more likely to have long-term care insurance. Interestingly, people working with a financial professional reported better average physical health than other survey participants. More recently, we completed work in late 2024 through early 2025 on market risk. That involved looking at how well people protected themselves and their portfolios from systemic events. Specifically, we defined market risk as the potential impact to financial resources resulting from market-wide events. One interesting thing we found when considering responses across actions taken and attitudes reported was that some people who describe themselves as risk averse might be putting themselves actually at greater risk. As you might expect, higher incomes can provide a buffer, and as you know, that isn't the full story. How they structure their household finances and approach their investments also plays a role. Consistent with other studies, when we ask about investment risk mitigation strategies, diversification was the leading answer. The challenge, of course, is that diversification addresses non-systemic risks, and it may be inadequate for mitigating the impact of market-wide events. What's more, as I noted with previous studies, financial advice is valuable. In this study, we found that advised households tended to be more well-equipped to deal with risk. Meanwhile, when it comes to systemic risks like market risk, insuring against the risk can be an appropriate strategy. And annuities do offer the types of guarantees that can help address market risk. Moreover, a majority of financial professionals we surveyed are using the guarantees annuities can provide to offset their clients' risks. And our most recently completed study is on policy risk, primarily involving federal government policies and programs. Some of the key themes we found were retirement delays are linked to policy uncertainty. About 1 in 5 pre-retired investors indicated that they had decided to postpone retirement since early 2025 with policy uncertainty, particularly around trade, political polarization, and federal spending playing a major role in their decision. There's tax sensitivity across generations. So we also look at generational cohorts. We typically have baby boomers and Gen X at least in these studies. And we found that a potential 5% federal tax increase would prompt spending adjustments for many investors. But for Gen X, they anticipate a greater personal financial impact compared to baby boomers. Third, generational differences in financial confidence. Gen X investors report rising concern about their financial futures, while baby boomers' confidence levels remain relatively stable despite their heavier reliance on government programs. Additionally, we saw that Gen X investors are increasing their use of protective and diversified strategies. Gen X investors are more likely to own and have expanded their holdings in downside protection products, such as index-linked or structured annuities, and they're showing growing interest in international and alternative assets. Different economic perspectives between investors and financial professionals. We saw that nearly half of financial professionals view the economy as stronger than a year ago, compared to only about a quarter of investors, reflecting how professional experience shapes differing perceptions of the same economic environment. And there are opportunities for more policy-focused client conversations. Many financial professionals limit policy discussions due to concerns about appearing more political or because of client sensitivity. Yet this presents an opportunity for more open, informed dialogue on how policy changes could affect retirement outcomes. The similarities between investors working with and without financial professionals suggest the issue is not only how often policy topics come up in the meeting, but also the professional's comfort level with raising them. Meanwhile, investors anticipate a higher likelihood of changes to government-provided benefits and taxes than financial professionals do. But policy conversations aren't keeping pace. We see here that perception gaps may result from not having discussions about policy issues and the investor possibly not having context to effectively evaluate the risk of each scenario transpiring. So with that, I thank you for your time, and I'll open it up for any questions you may have.
Perfect. Glenn, I appreciate it. And to remind everybody, we can use the Q&A function inside of the app. I always tend to get my text messages too. I was gathering a couple of those that came through, as well as emails. So chealy@theadvisornetwork.org if anyone wants to do an email. So I think one of the stats I actually got 3 separate things on this that you brought up, and it's very interesting that you said 60% of those polled were ready to spend down basically their savings and accept the Medicaid option. And the question, I'm going to merge the three of them together and kind of come to the bottom of is, do we think that's because these folks aren't planning? They don't understand the options that are available to them, whether it be a trust or naming other folks and, onto a deed of a home or otherwise. What are some of those things that might ultimately be responsible for that, Glenn?
Yeah, so there's a couple of dynamics that we saw in some of the other questions in the survey. First and foremost, investors don't foresee the need for long-term care at anywhere near the rate they're likely to experience that need. It was somewhere around a third thought that they were likely to need long-term care. And as we all know, the average in the US is about 70% in the course of your life. So they're not seeing it ultimately as a significant threat. That's a piece of it. Interestingly, those that have family members who have experienced long-term care needs, particularly due to cognitive decline, were much more likely to be oriented towards protecting against it. So you've got that dynamic. Second thing is there's a lot of confusion about how these programs work. So I think a piece of it is that many people understand, rightly so, that Medicare covers everyone in retirement, but they're conflating long-term care coverage provided by Medicaid with the universal applicability of benefits provided by Medicare. And as we well know, long-term care is a 30-day coverage with some significant cost sharing that takes over after that. And combined with, I don't think people, we didn't have the question in this study, but in others, we have found that people are not aware of the significant spend down that's required, the very low level of assets that most states have, the low level of income, and they don't recognize that there may be strategies, as you alluded to. There's ways using either a trust or other instruments, putting money into a Medicaid annuity that can potentially preserve those assets for them. Looking ahead, doing lifetime giving prior to the look back period, all potential strategies. But what we found that is kind of jarring, many advisors are not talking about this. It's really a topic that is a significant planning gap. And I think that's the biggest piece. One of the themes across all of these studies, people that get advice on the topic are just faring better in the situation. For example, people that got advice on how to deal with rising prices, people that are getting healthcare advice, they're just structuring because they're getting the perspective from the advisor. And the advisor also is using data. They're fact-based. They're not looking at yesterday's news story to decide how they're going to structure their plan. And that's also a very important component as well.
I'm going to elaborate on one of the three questions because you just touched on a component of that, which the look back, the planning that needs to happen on this is not somebody entering necessarily their 60s, 70s, or 80s. These discussions should often be happening a lot earlier. And the question was really that I morphed it in. What's the right time to do it? I feel like I know your answer, but I'm going to let you tell the other 7,000 people that ultimately might be hearing about that. When's the right time to plan for this?
Yeah, so there's two ways I could answer that, which is just in absence of any um, lifestyle or life stage issues with the client. And then I would say probably in your mid 40s, you'd start thinking about it so that you've got time to accumulate. As we know, compounding is our friend when we have significant expenses in front of us. The reality is, as we know, life gets in the way of retirement planning. So in our we do a lot of studies over the course of a year. We probably I've been with Jackson 8 years. There's probably better than 50 studies we've done with retirement investors and financial advisors. The reality is life gets in the way. It's probably early to mid 50s before people are really turning in earnest to retirement planning. But that's still time. There's still a horizon because, as we know, long-term care really doesn't become a significant event until you're in your late 70s or beyond. And a 20-year horizon to plan for and accumulate assets or structure a portfolio to handle those expenses is a reasonable amount of time to accomplish the task.
Yeah, and I'll just say to answer that from personal and within our own practice, New York State, the 5-year number is the look back. And if somebody is calling you because they're going through a traumatic medical event, you've now, now 5 years ago was the time to do it, but 20 is even better than that if we can do that. Um, Glenn, I'm going to really start by saying thank you on behalf of all of us at the Advisor Network. Which did today was not necessarily even talk about a product, which Jackson has a number of products that solve a number of the risks that you brought up, but to tie that in with academia and research is a great way to marry the two pieces. So maybe why don't we end for a moment on this between you, Glenn, and even Dustin, if it makes sense. Just talk a little bit about how those two things can get solved with some of what Jackson has to offer.
Yeah, for sure. I'll start off, and then Dustin, please come in on this. There's a couple of key ways that using an annuity can help benefit a client. In fact, we've got a couple of studies coming out. They're in compliance review and development right now. They should be coming out later this year, and there will be associated webinars with them. One is the impact of adding a fixed indexed annuity with an income benefit to a 60/40 portfolio. So we took as a baseline how a 60/40 portfolio and drawing income over the course of a 25-year retirement with a 10-year run-up would work. So stochastic analysis, stuff we're all very familiar with. And then we assumed, given that a FIA would potentially operate, one theory is, as a synthetic bond, fund a 20% allocation from the bond sleeve into the FIA with the income benefit. So you've got basically a 60/20/20 portfolio. We found that it had a significant beneficial impact on internal rate of return. It improved outcomes from the perspective of failure rate. There's a number of different perspectives around how that benefited the client and left them in a better position ultimately. And then there's also the notion, one of the things that I think gets advisors suspect is typically with an annuity, the income can continue long after the contract value is depleted. And one wonders, how's the insurance company doing that? And is that a promotional gimmick? And how exactly does that work? And the answer is mortality credits. When you can pool risk across a group of people, nobody can predict when a single individual will die, but actuaries can predict with great precision when the average person will die in a population. And so we can price the products and reallocate. It's basically a form of return on the portfolio, if you will, that helps pay that income benefit. And so that's one way. Another that we have looked at, volatility. This is a huge issue in the decade spanning retirement. So 5 years leading up to 5 years after. As we know, sequence of returns risk can significantly increase the likelihood of a portfolio depleting in your lifetime. And there are ways to guard against that. In the past, it would be structured products, and it was a fairly complicated answer. A RILA, registered index linked annuity, with a buffer on the downside and a cap to pay for that, certainly. We have looked at from two perspectives. One is, would having held money in a RILA-like object, looking back at bear markets to the 70s and looking at specifically at S&P 500, since it's a very popular index, we found that in the four major bear markets that have occurred between then and now, that you would be better off having put some money into a structured product like a RILA. You're insulating the portfolio, and the upside potential is not costing, because of the cap, is not costing you. You're actually benefiting more from the downside protection. In a strong bull market, certainly that's not the case, but in a bear market, a sideways market, weak bull market, there are potential benefits depending on the different structure of the buffer. And another thing that we're looking at, and then I'll wrap up, is the idea of risk protection. So I've also looked at the four different market regimes. So a bear market, a sideways or flat market, a moderate bull market, and a strong bull market, and how different risk dynamics within the portfolio benefit from having money in a RILA. And net, I found that it's a bear market or a modest bull market where you get the most benefit. Sideways markets, interestingly, have because of the dynamics, you don't necessarily get as much benefit. It's all explained in the paper. And certainly in a strong bull market, you just want to run with the money. Caps and buffers are going to constrain you in ways that would potentially outweigh the risk benefits from having money in the product. But those are two key ways that potentially factoring an annuity into a portfolio management strategy can potentially benefit the client.
Yeah, and you touched on an important piece there, and we'll wrap here, but I think part of it is we don't know what tomorrow is going to bring, or, 27, 28, and those folks getting ready for retirement now. If you could predict it, I'd say go for it, but we don't get that choice as we go. So let me pause here and say, Glenn, thank you very much for being a part of this. Dustin, we appreciate you hosting. We appreciate Jackson being a partner of the Advisor Network, and for everyone watching this a bit later on, as it's released. Thank you all for being a part of the Advisor Network Connect 2026, and we look forward to seeing you soon. Have a good afternoon.